Welcome back. Investors appear to be cheering softer producer price index data in the United States today. The PPI index rose by less than expected, and that's giving investors confidence that the Fed could start cutting interest rates in September. Let's get some thoughts from David Dietze, managing principal at Peapack Private. David, thanks a lot for joining us. What is your take, first of all, on that economic data released this morning, the PPI index, a measure of so-called wholesale inflation?
Hey, Paul, it was really a Goldilocks number because the PPI came in up just 10 basis points, which is less than the expected 20 basis points. But it wasn't so far short of that it ignited recessionary fears. So the positive here is that the market sees the Fed continuing to be on track to deliver a rate cut, or as some people are now calling it, rate normalization move in September, and probably continue with more rate normalization moves through the rest of the year. We've got also, of course, lower interest rates. We saw that 10-year Treasury move down from 3.9 to 3.85. So obviously, the bond market saw that as an anti-inflationary metric. And of course, we see the U.S. dollar moving lower. It's now got a 102 handle versus 103 before the day started. So that is also favorable for the revenues and profits of exporters.
What has happened to the U.S. small cap sector? It wasn't that long ago that we were talking about the great rotation out of NVIDIA, Alphabet, Meta, Microsoft, and so on, Apple, and so on, and into smaller cap stocks. And we saw the Russell 2000 index, the key benchmark of U.S. small caps, soar higher. We've since seen it almost collapse, and it's essentially back to where it started in the middle or latter portion of June. What has happened to that great rotation?
Absolutely. So the problem for the small caps is that they are more cyclical. They have more cyclical economic characteristics versus some of those mega cap large techs, which are seen as secular growers. And so when we saw recessionary fears creep into the market, and that was, of course, ignited by the softer than expected July non-farm payrolls number, where we only increased payrolls by 114,000 jobs, and that jobless rate jumped up from 4.1 to 4.3. And so because of that, people threw all the small caps out, saying that if we're going to be in a potentially harder landing than expected, we don't want to be in the smaller caps. But then later on, as we isolated some of those concerns as to link to what was going on in Japan and the end of the carry trade, A, and B, of course, we saw, for example, the service index number, the ISM service index number jump remarkably. I think some of those recessionary fears have been pushed to the back table. Now, yesterday was a soft day for the Russell 2000, but today I'm seeing the Russell 2000 almost neck and neck with the S&P 500, which is an extremely good sign that confidence is coming back in that we can avoid a hard landing.
You like international stocks and emerging market stocks, which is, of course, a subset of the international equity world. I'm interested in why, and in particular, is it at least partly because you believe U.S. stocks are extended?
Yeah, absolutely. So when you look at the U.S. stock market, most of the overvaluation and the big earnings hikes are being driven by those Mag 7, the global mega cap techs. But when you strip those out, the valuation isn't so severe. Nevertheless, if you go over to Europe, which is really tech light, their valuations are much more reasonable. The dividend yields are almost double what you can get here. And, if you look back in history, you see the baton being passed back and forth over long periods of time, of course. And so we think that certainly overseas stocks could be poised to outperform. I think the key metric to watch here is the value of the U.S. dollar. If the U.S. dollar starts to slip, I think you're going to see more interest in money flowing back into overseas stocks, taking advantage of those larger dividends. In terms of emerging markets, of course, one of the fastest growing economies on the planet over the long haul is still China. Yet they have some of the lowest valuations on the planet. We know there's problems there. There's questions about the real estate debt. There's questions about the political leadership. But there could be some explosive gains down the road if those problems can be addressed.
A story that got a lot of attention in this part of the investing world yesterday was Bank of Nova Scotia buying a significant piece, not a majority by a long stretch, but a significant piece of Key Corp, the operator of Key Bank in the United States. You've got some interesting thoughts on that. What is Scotia doing here, in your opinion?
Well, certainly it's a great deal for Key Corp because they were able to sell a 15% stake for cash to Nova Scotia at a price above what the stock was trading at, and that allows them to take some of the pressure off their balance sheet, give them a lot more flexibility. I'm scratching my head here as to what Nova Scotia's strategy is. Usually when a smaller company or a company needs a cash infusion and they want to go to a single provider, single investor, there's a below market price to incent that investor to put that 15% in. That's not what Nova Scotia did. It paid a premium. Now, people do pay a premium, of course, when they're taking control of the company. But what is the control Nova Scotia getting? They're getting 2 board seats. And on CNBC yesterday, the chairman of Key Bank said, no, this is not the first step in a takeover by Nova Scotia. So, I mean, they're kind of acting like an activist here, putting pressure. They've got the 2 members of the board. However, activists don't pay above market prices for their purchase. So I'm kind of scratching my head as to exactly what the strategy is.
We're almost out of time, but I'd love to get your take on a fascinating story today. Starbucks and Chipotle. One individual leaves Chipotle to go to Starbucks, leaving the CEO job at Chipotle, taking the CEO job at Starbucks. The market reaction could not be more dramatic. Starbucks shares up 22%, Chipotle stock down 8%. Explain this to us.
Certainly, Brian Niccol, who was the CEO of Chipotle, done a fabulous job. He's a rock star in the financial world. Starbucks was being undermanaged. His transition caused, of course, Chipotle to take a dive. Starbucks have their biggest gain ever on record. What's the message for investors? You know, everyone talks about invest in companies with good management, but just be cautious there, because there's only one thing worse than investing in a company with bad management, which is investing in a company with good management, which is very fully priced, if not overpriced. That was the situation with this Chipotle. And then when that management leaves, you can see what's happened. So, you know, management is always in flux. You know, the guy at Starbucks is only there for 16 months. So always keep your antenna up. If they basically have a great franchise but being undermanaged, there could be a management change, and maybe that offers an opportunity here. And that's what happened for Starbucks investors.